Two people, same income, same savings, same goal, build wealth, but one invests randomly, the other follows the right order, and 15 years later, both have invested money, but only one has real financial stability. Let's break it down. Ryan gets his salary. He opens his investing app, stocks, crypto, mutual funds, whatever is trending. It feels productive, because money is moving. Every buy feels like progress. Every green number feels like growth. But behind the scenes, no emergency fund, some credit card debt, no clear structure. So one unexpected expense, and everything gets disturbed. Daniel earns the same, but he doesn't start with investing. He starts with protection. Step 1. Emergency fund. Not for returns, but to stop panic. If something breaks, if income slows down, if life becomes uncertain, you don't touch your investments, you stay stable. Ryan ignores this. He thinks money should always be working, until a sudden expense hits. He sells his investments at the wrong time. Daniel doesn't, because he planned for it. That's the first difference. Step 2. Remove high-interest debt, because debt quietly eats your progress every single month. If your interest is higher than your returns, you're not building wealth, you're just covering losses. Ryan keeps investing while paying heavy interest, so even when his portfolio grows, a part of it is being cancelled out. Daniel clears it first. No excitement, no quick wins. Step 3. Take free money. If your employer offers matching benefits, take it, because this is guaranteed return. No risk, no waiting. Ryan skips it. He thinks he can do better elsewhere. Daniel takes it immediately, because before chasing uncertain gains, you take the certain ones. That decision alone changes long-term outcomes. Step 4. Start long-term investing, but keep it simple. Mutual funds, index funds, consistent monthly investing. No guessing, no reacting to every market move. Ryan keeps jumping, one trend to the next. He feels active, busy, involved, but activity is not always progress. Daniel stays boring. Same plan, same consistency, and that consistency starts building momentum. Step 5. Use tax-saving options, because returns matter, but what you keep matters more. Ryan focuses only on gains. Daniel focuses on net results, after tax, after cost, after time. That small shift makes a big difference later. Step 6. Increase investments slowly. Every raise, every bonus, every extra income. Daniel doesn't upgrade lifestyle first. He upgrades investing first, a little more every year. At first, nothing looks special. Growth feels slow, almost invisible, but compounding is working. Silently, then suddenly, it becomes powerful. Year 5. Ryan feels confused. Too many decisions, too many changes. Daniel feels stable. Everything is clear. Year 10. Ryan has ups and downs. Daniel has direction. His system is working without constant effort. Year 15. Both invested. But results feel different. Ryan chased opportunities. Daniel focused on order. Ryan asked, "What should I invest in?" Daniel asked, "What should I do first?" And that changed everything. So here's the smartest order. First, emergency fund. Second, high-interest debt. Third, employer benefits. Fourth, tax-saving options. Fifth, long-term investing. Then, extra investments. Simple, but powerful. Most people skip steps. They jump to the exciting part and ignore the foundation. That's why progress feels slow, because wealth is not built by random smart decisions. It's built by doing simple things in the right order. So before asking, which stock should I buy? Ask this instead. Is my base strong? Because if the base is strong, even simple investing creates wealth. That's the smartest way to invest your money.